Hello, thank you for joining us for Getting Ready for Tax Time. For today's session, we will discuss how to better prepare for filing your taxes for 2022 and beyond. There are many things that you as a child care provider should be mindful of when preparing your taxes. You will see that by assessing your previous tax returns, it can help you better prepare for this tax season, and we'll review resources and tools that are available to help you do so. Please keep in mind that this presentation is for education, not legal or tax advice. We have some important goals for today's session to assist you with being informed and well prepared going into this year's tax season. We will review last year's taxes and notice how they can inform the direction you need to take this year. Look at key opportunities for this year and what support is available to you as you get ready for tax time. Our research on past taxes illuminates the opportunities for you and your business now and going into the future. The Luminary Evaluation Group analyzed 60 child care business federal tax returns from 2019, and while there were a number of observations from that analysis, here are some of the key findings. 83% of child care providers that operate out of their home did not claim business use of their home at all. The IRS allows for these deductions on Schedule C, line 30, which is the business use of home. You can take deductions associated with those costs. However, through analysis, it was found that 83% of home-based child care providers did not claim those expenses at all. The next finding is that in some cases, providers didn't claim any expenses on their tax returns at all. And this is something that you would never want to have happen in any business, but especially in a child care business where every dollar is so important to put back into your program to run these essential services. There's undoubtedly a number of expenses that a child care provider has in order to operate, so there should never be an instance where a provider is unable to find or claim expenses that are associated with their child care operations. On the Schedule C, the IRS has a number of expense categories under which deductions can fall, and we do encourage you to take a look at each of those expense categories to see if you've had any expenses at all that qualify, and if so, you want to be sure to claim them so that you can lower your tax liability and the amount of money that you will have to pay taxes on. The next finding is that many providers were claiming certain business expenses which can drastically increase their chances of an expensive and time-consuming audit by the IRS. So while we do advocate for providers to claim valid expenses, the key word is valid, and not all expenses will be valid associated with running your child care business. There are expenses that could trigger those audits and are automatic red flags for the IRS. These could prompt a detailed audit. A rule of thumb, what the IRS considers a valid deduction, is one that is ordinary and necessary, so one that is required for you to operate your business. The IRS is evaluating expenses that are appropriate based on your business type, and they do review your tax return looking for appropriate expenses. The other key finding was that several common deductions were often miscategorized or improperly calculated, and when present on your taxes can again raise an automatic audit alert. While some deductions were valid, it was found that child care providers were just unfortunately putting them on the wrong expense line or possibly not calculating them according to the rules and guidance of the IRS. An example of one of those deductions would be children's meals. It was found that many child care providers were using the deductible meal expense, which is included on Schedule C. They were using them for children's meals. However, that is not the intention the IRS has for that particular line. And if they see a high number or something that you know would cause them to wonder, why does child care program have such a high number in these deductible meals? Those deductible meals are supposed to be business meals when you're out traveling or at a conference of sorts. And that could prompt an audit, and the provider was not intentionally doing anything to defraud the system. They did have a large number of children's meal expenses. However, they put them in the wrong category, and that would prompt an audit alert. Knowing how to effectively address taxes can help you, 1, keep your hard-earned money. While it is the responsibility of every business to pay their fair share of taxes, Proper tax preparation can be a vehicle for recapturing your hard-earned profit and keeping more money in your pocket. Understanding allowable expenses results in legitimately paying less taxes and retaining profits. 2, you can reduce your chances of a costly audit. Education is key when it comes to understanding allowable expenses and properly preparing your taxes. The more that you are aware of the tax rules as they apply to childcare businesses, the less likely you are to trigger an audit. Audits are very time-consuming and can cause distress, and at the end of the process may prove to be very costly, as an audit will most likely result in owing money that you may not have been prepared to pay. Another reason is that you want to know how healthy your business is. Reviewing your taxes is a fantastic way to evaluate the health of your business. Having an accurate accounting of profit really allows you to understand the financial position your business is in and can help you plan for changes going into the future. And finally, caring about your taxes helps you to not worry. Knowledge is key. Having confidence in knowing that you have properly claimed deductions and have met your tax obligation removes the factor of the unknown. Understanding taxes gives you the ability to continue to operate with the mindset that you are following the rules set by the IRS and are unlikely to have unforeseen debt and potential future problems. Small businesses play a critical role in our economy, generating income and wealth that supports the financial needs of entrepreneurs, employees, and their families. However, the cost and stress associated with filing business-related taxes do limit the positive financial impacts of self-employment for many entrepreneurs. Taxes are an important consideration for any business. Through taxes, we all contribute to our government at the national, state, and local levels. As a business owner, they are costs that reduces your profit. While you should always heed IRS regulations, you will likely want to reduce any costs to your business, including taxes. Effective tax preparation can head off long-term costs of an audit. Though only relatively few people are audited every year, if you are audited, the cost in time and money can be great. The best way to avoid an audit is to keep in mind common red flags. That is, the issues that are often lead to an audit. The most common red flags for home-based childcare providers are not including all of your income on your taxes, such as leaving out a 1099 you received from the Child Care Resource and Referral Agency for subsidized care. Taking off too many expenses or ones that are very high, like a provider who claimed $40,000 in cell phone expenses for themselves each year. Taking a very large loss on your business or having losses year after year. Business will take a loss from time to time, but you want to avoid having losses that are far in excess of what you earned. After all, if your business regularly loses more money than it earns, the IRS may be curious about why you continue to operate it. Claiming 100% use of your vehicle can also increase your risk of an audit. Some of you may have a van or car that you use for transportation for your business. That's allowed. However, reporting that the vehicle is only used for work and never for personal reasons can draw attention since it is less common. As you can see, many of the red flags can be easily avoided through proper preparation of your taxes. When it comes to preparing your taxes, there are a number of different tax forms. Income for sole proprietorship is reported on a Schedule C form as part of your personal 1040 tax return. If you have more than one business and they are not closely related in nature, you will need more than one Schedule C. For example, if you have a craft business on Etsy and drive for Uber and Lyft, you will fill out 2 Schedule C forms. When completing your Schedule C, you first report your revenue, that is, all the money you receive from your business. You then show all of your expenses, the things you paid for to keep your business running. And then you calculate the amount that remains. If it is positive, you made a profit. If negative, it is then a loss. Now let's take a closer look at the Schedule C to view the different sections for reporting data on your business. If you use tax software, you will enter these numbers based on your answers to certain questions, but it can be helpful to know your way around this important document. Now, Part 1 is where your sales are totaled and your cost of goods sold is reported so that you can see your gross profit. Part 2 is where your business expenses are reported. There are over a dozen categories listed to help you stay organized, such as advertising, car and truck expenses, legal and professional services, rent, travel, and meal expenses, as well as other costs. The last section is where your net profit is calculated, which is on line 31, by subtracting your total expenses from Part 2 from the total revenue in Part 1. Your net profit is considered your income from self-employment. The first section of your taxes is all about revenue, that is, how much money you made. Getting this information may be easy if you have an accounting system. If not, no worries, you can use the steps below to help you calculate it. You'll want to start by gathering your records. You are likely to have 3 types of records for revenue. Your 1099 forms, these are evidence that another business paid you for services. Many home-based childcare businesses will receive a 1099 NEC for the subsidy care payments and for participation in the Child and Adult Care Food Program, the CAC-FP. You will also receive a 1099-K if you receive more than $600 in business payments from apps like Zelle or PayPal. Bank records, showing additional funds you may have received from other sources, will be noted on your bank records. And your own documents, such as year-end or weekly receipts that show how much parents paid for care. To help you, you can fill out a revenue worksheet like the one shown on the screen. You would include each 1099 and the revenue for each child you serve. You would also list other income, such as grants, that may not already be accounted for on a 1099. If you received reimbursement for food costs through the Child and Adult Care Food Program, you can report all of the reimbursements under the income section of Part 1 of the Schedule C using the 1099 you received. You can then deduct your food expenses in full in the expense section. Now that you have your business income, we need to collect your expenses, such as what you spent money on for your business in 2022. We want to make sure you have records of your costs, ideally receipts showing payment for expenses, but you can also, in most cases, use canceled checks, invoices, or credit card and bank records. It is critical that any proof of an expense show that you paid the expense, the amount that you paid, the date that you paid it, and a description of the item purchased or the service received. One exception is mileage deduction for your vehicle. In this case, you should have a simple log with the date, the distance you went, where you went, the purpose, whether it's business or personal, as specifically as possible. The mileage log included as a resource in the guide is a simple log you can use to fill in your vehicle use information. Collect your expenses, begin by collecting all your receipts. Next, go month by month in your records for 2022 to review your credit card bills, check those app-based system payments such as Venmo, Zelle, PayPal, and Square Cash. Look at your bank statements and checks. With your accumulated expenses, you can now fill out the expense worksheet included in the guide. The worksheet uses the expense categories for Schedule C that are most relevant to home-based childcare providers, but they also can be used for any corporate or partnership tax return as well. The full amount of home expenses that are directly related to your business can be included in your expenses in the table. The IRS defines a direct expense as one that is incurred exclusively for the business and provides no personal benefit. Some examples of direct expenses in your home are fixing a bathroom that is used only by the children, getting a new children's rug for the play area, and playground equipment. Indirect costs associated with your home, such as homeowner's insurance or your electric costs, will be covered in the following section, which covers your business use of home. You should hold on to all proof of payment through the tax season and at least 4 years after. It's great to have paper copies as well as electronic ones, even if that is just snapping a picture of each with your phone. By assessing last year's Schedule C, you now know how to prepare this year's taxes. There's a free tool available to you that we, Civitas Strategies, developed through the partnership with the Wisconsin Early Childhood Association. This free-to-use online app, accessible from a computer or your phone, walks you through a series of yes or no questions about last year's Schedule C, and then the app will email you a PDF of your answers along with an explanation of how you could best utilize that part of the Schedule C. The PDF also contains embedded links to resources to help further explain the answer. This PDF can then be shared with a tax preparer and used when completing this year's taxes. By completing this assessment, you are now more aware of your opportunities and risks as you move ahead. This tool is available in English and in Spanish. In English, you can find it at civitas-rubric-eng.glideapp.io and in Spanish at civitas-rubric-esp.glideapp.io. If you want to complete your own taxes, there are online guides available for you to use as you do so. These guides are designed specifically for the child care provider who wants to use online tax software. We have guides available for TurboTax, H&R Block, and TaxAct, along with a buyer's guide to help you choose the software that best suits your needs. So how do taxes work? Self-employed small business owners are subject to a 15.3% self-employment tax of their net earnings, or the profit remaining after all of your expenses have been subtracted from your revenue. Additionally, you are still subject to your general income tax rate on your profit. Your business expenses can be claimed as deductions on your taxes, which ultimately impact the amount of money that gets taxed and potentially the rate at which you are taxed. Your profit is the number you get when you take your revenue or money coming in and subtract your expenses or money going out. As you can see, doing your taxes fairly can help you reduce how much you owe. In our example, if a sole proprietor were to bring in $35,000 in revenue and claim no deductions, they will be subject to a self-employment tax on the whole $35,000 and taxed at their general income rate on $35,000. If they bring in $35,000 in revenue and claim $5,000 in deductions, their profit is reduced to $30,000 and they will only be taxed on the $30,000 in profit. Here are some key opportunities for you to save money or decrease your audit risk. When preparing your taxes, it's important to know that there are some deductions that are common for child care programs to claim that are often overlooked. Here are the ones that many providers miss that may provide an opportunity. Business use of home. Home-based child care providers can claim the business use of home on their taxes. To determine the business use of home, you will use the time-space calculation to find the percentage of time and space that your home is used for business purposes. This percentage can then be applied to expenses associated with your home, such as rent, utilities, or mortgage interest. Insurance. Business-related insurance costs, such as liability insurance, can be claimed on your taxes, but this cannot include personal or health insurance. Mortgage interest. For child care programs that are not home-based, mortgage interest for a business property that you own can be claimed as a deduction. For home-based providers, this would already be captured in your business use of home calculation. Wages, total salary and wages for the year for W-2 employees and yourself, if you pay yourself through payroll, can be deducted on your taxes. Do note that 1099 employees cannot be claimed in this line, only W-2 employee wages. And supplies. Supplies are another commonly overlooked deduction. This can include classroom supplies, learning materials, toys, diapers, wipes, and cleaning supplies, and so on. When considering deductions, there are some topics that encompass very common tax deductions, such as home, food, transportation, and the depreciation of your assets over time. Let's look into each of these opportunities more deeply. Our first common deduction is the home deduction. In order to take the home deduction, you must use the time-space calculation. You may feel intimidated by the time-space calculation, but if you take it step by step, it becomes easy to understand and to use for your tax calculation. How does the time-space calculation work? There are 6 key steps to determining your space. Step number 1, determine the square footage of the area in your home that you regularly use for child care space. Step number 2, Divide the square footage of that space by the square footage of your entire home to determine a percentage. Step 3, determine the amount of time your home was used for childcare during the year. Step 4, divide the hours your home was used for childcare by the total hours in a year. Step 5, multiply the percentage of the space used in your home by the percentage of time your home is used for business to determine what percentage of your in-home expenses are for your business. And step 6, divide the exclusive use space by the total square footage and add it to the result of step number 5. The only business in America that can have two different types of business use space is family childcare. You can have exclusive use and regular use. Let's look at the definitions of both exclusive and regular use. Exclusive use must be 100% of the time. Be judicious, the IRS can inspect your home. Exclusively used space is 100% deductible. Regular use for business means an ongoing, regular basis. It can even be 1 or 2 days a week. Regularly used spaces are deductible using the time-space calculation. Let's look at a few real examples from our work. An example of exclusive use. You have a basement with a separate entrance for families that is only used for childcare. Another example of exclusive use is if you have a home storage area that is only used to store toys and supplies for the childcare business. An example of regular use would be if you use your 2 bedrooms daily at nap time for some of the children. And another example would be if on Wednesdays you use your living room for STEM learning. If a cost is for an exclusive area, it is likely entirely deductible. In a regularly used area, you need to use a time-space calculation to determine how much can be deducted, and we'll talk more about that in a minute. Some fully deductible costs would be exclusive use area costs, direct costs that are related to your childcare business. An example of that would be replacing the tile in the basement if it is only used for childcare. Another example would be installing a child-sized toilet. And another example would be your liability insurance. Partially deductible expenses, for instance, would be the regular use area costs, a common area improvement. An example would be replacing all the windows in your home. Another example would be repaving your driveway. And another example would be home insurance. Those expenses would only be partially deductible. For partially deductible home costs, you will use the time-space calculation. There are 6 steps in the time-space calculation. Step 1 is to determine the square footage of the area in your home that you regularly use for your childcare space. Regular use includes areas that may be used all day for care and areas that are regularly used only part of the day, such as napping areas or mealtime areas. You're going to add the square footage of each regularly used space together to determine the area of your home that you use for business. To calculate square footage, you will first need to measure the length and width of your space. Continuing on, you will use a tape measure, fix a tape measure to one end of the longest wall in your space, and extend it to the other end. Next, you'll record this measurement in feet, not inches. Then you will fix a tape measure to one end of the shortest wall in your space and extend it to the other end. Next, you'll record this measurement again in feet, not inches. After you've done that, you will then multiply the length measurement by the width measurement to find out your square footage. Length times width equals square footage. For example, if your space is 13 feet long and 10 feet wide, your square footage would be 130 square feet. 13 feet times 10 feet would equal 130 square feet. Next is step 2. You divide the square footage of that space by the square footage of your home to determine a percentage. You'll take the number of square feet of the childcare space and you'll divide it by the total square footage of your home. An example is if you use 500 square feet of your home for your childcare space and the home is 1,000 square feet, then the result is 0.50. Multiply that number by 100 to get the percentage, which would be 50%. Step number 3. Determine the amount of time your home was used for childcare during the year. So you're going to calculate how many hours your childcare space is open per week, making sure that you include the time you were spent preparing and cleaning up when the children are not present. Then you're going to multiply this number by the number of weeks you were open for service, and you'll add any work hours you performed while you were closed. An example of this is if your business is open 10 hours a day for childcare, but you spend an hour beforehand preparing and an hour after cleaning up, that's 12 hours per day, 5 days per week. Let's say you closed for 2 weeks due to the pandemic, but during that time you spent 10 hours maintaining the childcare space and preparing for reopening. Now let's do the math. 12 hours per day times 5 days per week times 50 weeks open plus the 10 hours you were closed equals 3,010 hours. For step 4, you'll divide the hours your home was used for childcare by the total hours in a year. For example, let's divide the 3,010 hours we calculated by 8,760, which is the total number of hours in a year. That gets us 0.344. You'll multiply that by 100 to get the percentage, which is 34.4%. Step number 5. Multiply the percentage of the space used in your home by the percentage of time your home is used for business to determine what percent of your in-home expenses are for your business. So you're going to take two numbers, the square footage percentage and the hours per year percentage, and multiply them together. Now in our example, that'd be 50% or 0.50 by 34.4% or 0.344. 0.50 times 0.344 equals 0.172 or 17.2%. This percentage is what you can apply to your joint home and business expenses for your in-home childcare service for reimbursement with grant funds and even when filing deductions during your annual tax filing. Step number 6 is to divide the exclusive use space by the total square footage and add it to the result of step 5. Note, spaces that are exclusively used for childcare will only be subject to the space calculation, not multiplied by the time percentage. Now, you must be able to prove and document that the space is exclusively used for childcare. Now, this should be evident by how you have set up the space. With exclusive space, you really need to be clear. For example, is a room filled with beds and blankets for nap time and has child's pictures on the wall, or does it look like a regular bedroom in your home? Our next common tax deduction opportunity is for food and meals. Now, the basics of the tax opportunity for food and meals are that food is fully deductible with 2 exceptions. The big question is how you do it. So fully deductible for children in your care, and you can report these costs in multiple ways. For staff, only 50% of your food costs are deductible. And for your own children, those costs are not deductible. There are only 2 ways to deduct the cost of food. Family or center providers can use the actual expense method. Only family child care providers can use the standard rate, and we'll talk more about what that means in a minute. You can deduct as a business expense 100% of the actual cost of food consumed by your daycare recipients, and generally only 50% of the cost of food consumed by your employees. However, you can deduct 100% of the cost of food consumed by your employees if its value can be excluded from their wages as a de minimis fringe benefit. Now, to claim the actual expenses, how do you do it? You keep track of all food expenses, including receipts. The pros of this method are that it includes all your costs. The cons are that there is a greater scrutiny and recording burden. The second method is the standard meal and snack rate. Now, to simplify record-keeping requirements, you can use the optional standard meal and snack rates that family daycare providers can use in computing the deductible cost of food provided to eligible children in daycare in lieu of actual costs. The rate is based on the Tier 1 rate under the CACFP. The provider may use the standard meal and snack rate for a maximum of 1 breakfast, 1 lunch, 1 dinner, and 3 snacks per eligible child per day. Now, this varies from the CACFP reimbursement allowances, which is typically 2 meals and a snack or 2 snacks and a meal. Only family care providers can use a standard rate. This is a lot easier to keep track of. You will use the Child and Adult Care Food Program rates. This is whether you participate or not. Now, how do you do it? You keep track of the meal types and the numbers and multiply by a set amount. The pros? Easier record keeping. You can still deduct non-reimbursed meals and snacks. The cons? You will still need to keep the name of each eligible child, the dates and hours of attendance, and the number and types of meals served, which is a great time to create a form. Now, what about the CACFP? Reimbursements you receive from a sponsor under the Child and Adult Care Food Program of the Department of Agriculture are taxable only to the extent that they exceed your expenses for food for eligible children. Now, the netting method, you would use this if your reimbursements are more than your expenses for food. With the netting method, you will show the difference as income in Part 1 of Schedule C on your Form 1040. If your food expenses are greater than the reimbursements, you would show the difference as an expense in Part 5 of Schedule C on your Form 1040. Do not include payments or expenses for your own children if they are eligible for the program. The netting method is not a preferred method since an examiner will always be looking for the food reimbursement amounts. When you report the amount separately, the examiner will more easily be able to account for the payments. Next, we'll review the tax opportunity for transportation. And as with all deductions, there are some very specific rules and guidelines that you will want to follow. On the screen, you will see all of the elements that you need to make sure that your transportation is deductible. Now, it must be in the regular course of doing your business, and it must relate directly to childcare, such as picking up the kids, or it must be business related, such as going to Costco to get milk, and you always need to keep personal and business travel separate. There is a primary rule for transportation. Trips can be for personal and business. It is only deductible if the primary purpose of the trip is business. An example of the primary purpose of the trip being business is example 1. If you go to Costco to get a long list of supplies for your child care center, and while you are there you pick up a jar of pickles for yourself, that would show that the primary purpose of the trip is business and it would be deductible. In example number 2, you're going to the supermarket getting your groceries for the week for your family, and then you remember you need a box of wipes for your child care business, so you get them while you were there. That would not be deductible because the primary purpose of the trip was not business. Now, there are 2 ways you can deduct your transportation costs. You can do it using all of your actual costs, or you can use a standard IRS per mile rate. When using the actual expense method, you'll capture everything, but you need to keep every receipt. And you'll also need a mileage log to track how much time is personal versus business. So you'll keep track of your personal and business use of your vehicle and proof of payment for all costs. A pro of that is that you're using all the costs for your vehicle, from the gas, tires, to lease payments or depreciation. The cons is that there's greater scrutiny and there is a recording burden. Alternatively, you can use a simple IRS mileage rate. You still, however, do need to keep a travel log. How do you do it? You keep track of your miles, the day, and the purpose on a simple log, or you use an app. The pros? Much easier to account for and less scrutiny. The cons is you are limited to the mileage rate, and in 2022 it is 58.5 cents a mile. Depreciation of your assets is another tax opportunity, and you will want to have a strong understanding of how you depreciate your assets for tax purposes. What is depreciation? Depreciation is a special method the IRS uses for deducting big expenses, such as those over $2,500. Sometimes, and we'll talk about it more here, there are times when you will have to deduct it over years, even if you paid for it all this year. and the result of that can be an increased tax bill this year. There are 3 special rules for depreciation that can help you deduct your depreciation faster. The first rule is Section 179 depreciation, which is allowable for tangible personal property, such as office equipment, furniture, vehicles, and most other assets that are not buildings or improvements to your building, including a home used for business. There is one catch, however. The item needs to be used for your business 50% or more of the time. If you are a family child care provider who wants to use this for an improvement to your home, you will need a time-space calculation that shows 50% or greater business use. For a vehicle, such as a van for transporting children, you need to show a 50% or greater use based on the total miles driven for a year. The second special rule is known as bonus depreciation, which allows you to deduct 100% of certain assets in 1 year without an upper limit on the total amount you can deduct. To qualify for bonus depreciation, the item needs to have a useful life of 20 years or less, so it doesn't apply to your home, and be used for business 50% or more of the time. This second part is an important one for family child care providers, since an expense, such as a driveway paving, that meets the criteria of having a useful life of fewer than 20 years may not qualify if the provider's time-space percentage is less than 50%. One exception, similar to 179 depreciation, is there are separate rules for vehicles. For vehicles under 6,000 pounds, you can expense $19,200. For vehicles over 6,000 pounds, but less than 14,000 pounds, they do not have a limit. Just like Section 179 depreciation, you need to use the vehicle at least 50% of the time based on the total miles driven, and the amount of depreciation must be adjusted by the business use. Bonus depreciation will continue to be 100% through the end of 2022. In the following years, the percentage of depreciation allowed will decrease, which starting in 2023, when you will be limited to 80% of value, until it ends completely in December 2026. The third special rule is known as Safe Harbor for Small Taxpayers. This rule comes out of the IRS Tangible Property Regulations and allows providers to deduct repairs or improvements to the business location that are lesser of $10,000 or 2% of the unadjusted basis. That is the value of the property less the value of the land. For example, let's say you had a child care center that was worth $350,000 and the land is worth $50,000. The unadjusted basis would be $300,000. 2% of the unadjusted basis would be $6,000. So an improvement like adding an awning that was $5,500 could be deducted in 1 year. For family child care providers, you would need to include the time-space calculation. With all 3 of these rules, it is important to note state limitations can vary, so depreciation, as described above, may only apply to your federal tax return. Do you depreciate? Let's run through it step by step. Your software tax preparer will do this, but it can help to know how it works so you aren't surprised. First is the expense over $2,500. This is even part of an expense. So if you had your roof replaced and you apply time and space and the business portion is only $3,000, you still have to check for depreciation. Second, is it a repair? A repair can't add value, so it needs to be of similar function and materials. For example, a provider replaced the wood on their deck where it was rotting, and they replaced it with new manufactured products. Is the material better? Yes, but it's basically the same function that the wood had. Let's take another example from a provider. They redid their countertops in the kitchen. They had Formica, and they replaced it with some really nice expensive granite. In this case, they definitely increased the value of the kitchen, and it's not the same material, though it is the same function. Third, is this equipment or a land improvement? Equipment is broadly defined, so it can include a lot of things. The child care provider may spend on such as a new stove. A land improvement is when you change your property, such as adding a fence or paving a driveway. Fourth is the total cost under $10,000. If so, there's a special rule for small taxpayers where you can still depreciate it all in 1 year. Fifth If you reach this point, you're likely going to have to depreciate it over a number of years. A final tax opportunity that you will want to address are how taxes relate to stimulus funding. For almost any type of stimulus money you have, the rule of thumb works. You have to report the money you received, but you're allowed to use any of the deductions associated with it. However, the timing of the deductions and the revenue can cause issues. Let's take a look at 3 scenarios. Here's the basic one. It's very straightforward. The provider received $10,000 in stabilization money, which they report as revenue, and they spent it on $10,000 in expenses in the same year. And in this case, nothing changes on their taxes. The revenue they must claim is $10,000. The expenses they can deduct, $10,000. Taxable income, there's $10,000 in revenue, $10,000 in expenses. That equals a taxable income of $0. Now, let's say the provider got the same $10,000, but only had $5,000 in expenses. In this case, you're going to have to either spend more or pay taxes on the $5,000 difference. The revenue they must claim, $10,000. The expenses they can deduct, $5,000. That gives us $10,000 in revenue, only $5,000 in expenses. That means the taxable income equals $5,000. Finally, let's assume that the provider got $10,000, but as with a lot of the stabilization, they were able to attribute it to spending that happened in 2021. Now, in this case, they would have to pay taxes on all $10,000. That's because the expense was from a previous year. So in this instance, the revenue is $10,000. They don't have any expenses this year that they can deduct. That means that the taxable income is $10,000. There are some free tools that you can use before tax season, during tax season, and after tax season to help you better navigate this challenging topic. Now, before tax season, look at your revenue and expenses. You'll want to have a system to track money coming in and money going out. Anything, it could be from a ledger to a bookkeeping system or a CCMS. Now, hours and mileage logs. You need to track the hours you work and plan. Miles can be a simple pen and paper log, or you can use an app. Also before tax season, for meals, you want to track the number of meals and snacks for children in your care, and you want to assess last year's taxes. You can use the free online tool from WECA to assess your taxes from last year. During tax season, you'll want to collect your information. You can use the Homegrown Tax Workbook or a similar tool to collect all of your information. Don't just rely on your tax preparer. And you can prepare your own taxes. WECA has an easy-to-use guides that can take you through using the big 3 tax programs to save you time and money. After tax season, keep your taxes. Keep your tax returns and all supporting documents for 7 years or more. And follow the Taking Care of Business blog for timely updates. You can visit the blog at www.tomcopelandblog.com. The Taking Care of Business blog is Tom Copeland's blog on family childcare business, continued now by Civitas Strategies. It provides a lot of answers. There are over 1,500 articles, and you have the ability to reach out to the Civitas team. How do you use it? It can be an excellent searchable resource for you as you move forward in your business. As for frequently asked questions, one question is, what time-space costs can I consider? Time-space costs could be rent and mortgage and depreciation, utilities including electric, oil, gas, water, garbage, compost, and solar panels, furniture such as desks, chairs, and tables, cleaning fees, extermination fees, and landscaping, kitchen improvements, appliances such as dishwashers, microwaves, washers, and dryers, your home insurance, property taxes, furnace repairs or replacement, patios and fencing, flooring and painting, windows and doors, home repairs and upgrades. All of those would be subject to time-space calculations. Another question is around stimulus funding. So keep in mind that the funding is taxable, but you also do get to take the deductions. You want to keep your records clear, not only for taxes, but also for grant monitoring. Now, the funds can typically not be used for construction, and they are subject to time-space calculation and to other proration. Another frequently asked question revolves around mixed personal use and expenses. So time-space is used for home and land improvements. Time can include the preparation and other time without the children. It doesn't have to just be the hours of operation. Proration methods need to be used for non-home items, such as a cell phone. A very common mixed personal use expense would be a cell phone, in which you would just expense business minutes, or cars, where you would expense either the mileage or the actual cost that you're using directly related to the business. And keep in mind that these types of calculations and considerations also apply to the use of your stimulus funds. You may have questions on finding a tax preparer. Here are some things you'd like to keep in mind. Are they qualified? Did they receive training? Have they worked with child care providers? Do they understand your specific needs? Are they available after tax season for advice or changes? And can you get a copy of your return? We at Civitas Strategies would like to thank you for joining us for our presentation on getting ready for tax time. We welcome you to please stay in touch with us. You can join our email list by emailing us at info@csearlystart.com. You can also find us on the web at www.csearlystart.com. We welcome you to follow us on Facebook and LinkedIn. We also would like to remind you about the Tom Copeland blog, and you can join the email list there by visiting www.tomcopelandblog.com/join-email-list. Thank you once again. Take care.